Because my big question is the slog in August that we've been dealing with, the precursor, as we say at the outset, for what's to come.
Yeah. Well, seasonally, this is not a great time for the markets, August and into September, right? Year-to-date gains, we've had huge gains, 15% in the S&P 500, 30% in the NASDAQ. We have a bear steepener happening in the bond market, right? Rates are rising, especially on the long end, which I think is surprising a lot of people. We just overall have uncertainty about the Fed, certainly with regards to Jackson Hole on Friday, and then like September, there's no earnings, right? So then we're like hostage to the macro. So I would not be surprised to see kind of volatility. Maybe we see a little bit of a pullback. That's normal. That's fine. But I got to point back to the economy, and the economy is hanging in pretty darn well, right? I mean, we talked last week about the 5.8% GDP number from the Atlanta Fed. I don't know if we're going to end the quarter there, but we're probably going to end the quarter something like 3.5%. And that's what's been the big surprise. And it has led by the consumer. And I know we get these bad headlines today with regards to a couple of companies, but it hasn't been negative across the board, Scott. Not yet. And that's because jobs are still strong, wages are still good, and services is still picking up the slack. So manufacturing, on the other hand, is mixed for sure, but we talk about this. The PMIs are bottoming, Scott, and I want to own that part of the market when you have depressed PMIs. I don't really want to buy industrials and manufacturing names when you have PMIs in the 50s. So right now, you're still in the 40s, but we're making progress there. And anything tied to onshoring, anything tied to aviation, that's really where you want to be.
Are we thinking, Jason, that what we've witnessed in August is just the start of what could be a dicey fall? Or not? I mean, just because history suggests that, you know, it can be, doesn't mean it will be. Right. You know, the adage "sell in May, go away" doesn't work every single time, obviously. Doesn't come to fruition. So what about now?
Yeah, no, I think Steph makes some great points. I think seasonality, to your point and Steph's point, obviously plays a key factor for sure. I think going into Powell's speech on Friday, there are strong cases for bear and bull cases. And I think he's got to really stroke the line. He's got to be neutral in his speech. Obviously, we look to last year and the speech that he made, and clearly the markets didn't respond well. There was a sell-off there and moved on to October lows, and then we've sprung up since then. So I think he's got to really strike a hard balance between the dovish and hawkish commentary and really acknowledge what has happened, because we have seen some growth in obviously inflation numbers have come down. The consumer is doing well. The economy is hanging in there. So I think he's got to acknowledge that, but also acknowledge that, hey, we need to tame inflation, keep it down for longer.
Yeah, we know, Shannon, that, you know, rates have made the market a bit uneasy. You're at the highest levels, obviously, since '07 on the 10-year. Barclays says, you know, maybe you got to get beyond 5% on the 10-year to get some real upset within the market. Yes, it's been volatile and it's been uncertain and edgy, the word that we've used, but maybe you got to go beyond 5 on the 10-year, and then we get real. What do you think?
Well, I think interest rate reversion is obviously the biggest threat that we have right now, particularly with multiples that have, you know, frankly been extended, you know, coming into this market. If we go back to the beginning of the year, we were looking at really two forces for growth that would push the yield curve higher on the long end, and that was the U.S. consumer and the Chinese recovery, and we haven't seen that growth. However, now there's expectation that with China and Europe, we're really the best house on maybe a not so great block. And so as you're seeing that yield curve start to steepen, there's really, you have to go back to some of the points that Steph made about what are the catalysts for the economy to continue to perform well? What are the catalysts for top line growth, for nominal growth to continue as we see slowing inflation? I think that's the challenge. I think we've talked a lot about margin in the first half of this year. We've really been focused on the bottom line because the top line is held in there just fine because of the inflation we've experienced. And so now, if we have to start worrying about top line growth and looking for catalysts to drive that, and how does that affect what the Fed will do? I mean, you talked about GDP, Scott. That is not good news for people that are pricing in 2 or 3 rate cuts next year in terms of valuing stocks.
Well, you say because the growth is too strong, which means the Fed is going to keep the pedal on the floor.
They have to remain restrictive. How can they cut rates if we're expected to continue to grow? Because that means that we will have continued growth, we will have stickier inflation, and wages, as we saw in these labor deals that we've experiencing over the last couple of weeks, they are not being pushed down either.